was Res Krishna Kumar, Chief Investment Officer of Equity at Sundaram Mutual Fund. He's joining us on the show. Mr. Kumar, thanks very much for taking out the time. A very volatile environment with regards to earnings, with regards to investor sentiment, with regards to stock price moves. How does one, what kind of solace does one take from what's been happening currently?
Yeah, I think if you look around you, I think there is a lot of negative data points that one can pick up, be it automotive sales, two-wheelers, four-wheelers, commercial vehicles, tractors, and slowing FMCG growth rates also. And you also see the credit growth slipping off, and the NBFC issues in terms of liquidity and stress continuing to haunt us. While these are, the situation we are in, the government has taken steps along with RBI to address the NBFC liquidity issue and try and provide more liquidity to them, bring down the cost of funding for the NBFCs and system in general, also try to give more confidence on the NBFC space. So all this would reduce also the credit spreads, and we should start to see cash moving across the system in the next couple of months. So coinciding with the festival season, you would see that data incrementally gets a lot better. If you also look at the last year, the economy started to slip sometime August, September. So we are probably in the last 1 or 2 months of a base effect, and then we would get the benefits of the base effect coming in from September. So we would then be a lot more, getting more positive point. At the same time, also this automotive pre-buying should kick in sometime into the second half, which will also help the overall economy. The government spending has been a little muted in the first quarter. I think with the budget behind us and the new government will get on with accelerating the project awards and project spends. So that should again restart a lot of the work on the infra side, which will have a fairly decent demand push across the economy. So I think all is not bad. I think if you do look at the next 6 months, you would find that we bottom out in terms of growth.
Krishna, good morning. Neeraj here.
Hi.
Wondering if you are perturbed with the commentary that is coming in from some of the marquee banking names, because that's not indicative of the stress just in their books, but the stress that could be there in the system at large. For HDFC Bank to sound off a bit concerned about the unsecured creditors book, RBL Bank referring to that as well in Friday's session. Is this a worrying sign at all?
So I think, with some of these, banks, it's been a more of one-off set of corporates who have slipped and they're showing up. And particularly with respect to the unsecured loan book and retail, I think, some of the banks are definitely quite cautious at this point in time, more selective about whom they lend to. The retail growth in few of the banks has been slowing from Q4 and Q1. So I think definitely, the system is playing on its back foot, given that they already have bad experience on the systemic stress. I think people are more cautious. At the same time, as I did mention, the budgetary provisions on securitization and first loss cover, these things are yet to kick in because RBI is yet to come out with a circular on operative guidelines. I think once that happens, 1 lakh crore of liquidity can come in, and along with that, the 1.34 lakh false CR liquidity is again going to be a boost. So that should provide succor, in my opinion, over the next 3 months.
Reckon, Krishna, then that you might be a buyer selectively. I'm not getting into what, but you might be a buyer over the course of the next couple of months if things improve, or would you reckon that you would rather, that a prudent investor could sit on the sidelines for the next few months, not invest anything even if it doesn't take out anything, because there might be better opportunities. The multiples might correct.
I think timing is always a difficult issue. If one tries to time the markets, I think you do lose the best days to buy. So I would continue to believe in doing a systematic investment into the markets. Try to get a good average in rather than trying to sit on the sidelines and timing the bottom of the market, which is very difficult. It's an elusive bottom. For all you know, it might actually be bottoming out as we speak.
Are you worried about the earnings performance and how we've kick-started Q1? And does that put a question mark to the full-year earnings projections?
Yeah, there are some downgrades in terms of growth in numbers. So we did start at the 26-27% earnings growth for FY20 about say 4-5 months back, and we probably are around to 20% or 18-20% kind of range. So I think this should stick for the year. Sans any meltdown in the economy, which I think is it's not even that we should build budget for. I think building in expectation of a recovery in growth into the second half of the year, I think we should be quite comfortable with 15 to 18% growth number. If it's even being conservative, I think a 15% number should hold definitely.
15%. So then, would that justify the 17 times multiple that some of these brokerages have been putting on Nifty targets towards the end of the year, when they say that Nifty could touch about 12,900 odd?
Yeah, I think if you do go into the end of the year, you would basically discount an FY21 number, which would be 17-18% higher than the number of 600 for Nifty earnings of FY20. So I think if you do build in discounting on the FY21 numbers, you would get to a far higher Nifty targets basically. So all we are saying is that these are tough times and there are extraordinary provisions that one is taking on the books, and so you are seeing a lot of depressed earnings in many sectors still. So just going with the PE as an absolute number and looking at 16 or 17 times being expensive may not be the right view. But I think a lot more important is to see, is the economy getting back on track over the next 24 months? And if we do build in an 18% CAGR over the next 2 to 3 years, and then we should be fairly comfortable with the 16, 17 times PE number for the market multiple. Having said that, the broader market, even in the large cap sans 10, 12 stocks, a lot of them are trading below 14, 15 times. So also on the mid and small caps, you are seeing the indices are trading at about 14 and 13 times on a year ahead earnings. So there is a lot of correction that has happened. A lot of stocks are quite attractive. If you look at BSE 500 and look at all the mid and small caps, you would hardly find even a double dozen of them which are in positive return territory over a 2-year period. So I think that's the kind of meltdown we had in prices and readjustment of the valuations basically. So I think the markets are reasonably pricing in the current weakness and probably underpricing the growth forward.
By the way, the Nifty Bank as we speak is down about 1.5% at 29,341. The Nifty is down about 0.8% at 11,328. And keep in mind what is leading these downwards. Bajaj Finserv down 3.5%, Bajaj Finance 3.5%, HDFC Bank is down about 2.5%. Today, IndusInd Bank is down 2%. Today we have a bunch of these quality names which are correcting in the session. So please be mindful of that. Krishna, my only counter to that would be that hitherto in India, we've had these broader end of the spectrum stocks correcting not because the world economy or even albeit the Indian economy has really collapsed. Individual accidents, I mean, you could argue started with demonetization, the ASM framework, and then GST, and then the elections, and the NBA ILFS issues, all of them domestic. We still haven't faced an international issue thus far, and while world markets are looking at substantially higher levels, what if they start to correct? Can this elusive small cap recovery get sidelined for a really long period of time?
I think what's happening globally in terms of softening growth in Europe and in US and the developed economies is actually quite positive for emerging markets. I think there's a clear differential of 2 to 3% on GDP growth across these economies and EMs. And clearly, if central banks globally looking at data, softening growth and low inflation currently, they are pumping in more liquidity. They are kind of looking to cut rates at this point in time. So these are situations which are very conducive for growth stimulus in the emerging markets. The central banks here will have a lot more leeway to go aggressively and cut interest rates because the currency is not going to take a knock because globally there is liquidity and rates are softening. So to the extent I think our real interest rates are still quite high, and there is a case to cut by 50 to 75 basis points on the repo and also try to bring down the credit spreads in the market. So I think cost of capital will come down, and that will be a major trigger for markets to kind of bounce off from the lows.
Okay.